If you've got a pit in your stomach, you're not alone. The S&P fell 10% last week and is now down 17% from its all-time highs. The catalyst, of course, was the Trump aggressive tariff announcement followed by retaliation from China. Good morning. This is James Perry at Perry Capital in Miami. It's April 6th. A lot of people have their hair on fire. We are going to try to snatch some logic from the illogical and explain what's going on and what you can do about it. Here we go. The FX market gets it first. The emerging market currencies got slammed on Thursday and Friday. They're down about 8% this year, and the dollar is up. The dollar is also up from its pandemic lows by 15%, and emerging market currencies are down 25%. China, India, Vietnam, and Mexico are all in that index. Their currencies are falling against the dollar for one simple reason. They cannot win a trade war with this country. Exports to the United States are paramount to their economic growth. The bond market gets it next. 10-year treasuries are trading under 4%, and the market is pricing in 100 basis points of Fed cuts in 2025. Many think this is a recessionary signal that's as clear as a bell. Maybe. I think it's a lower inflation story. Inflation swaps are actually falling. And if you look at credit spreads, they're really very well contained. Investment grade credit spreads on Inauguration Day were 75 basis points over treasuries. Now they're 109. That's a small increase. In the high yield space, they were at 250 on Inauguration Day. Now they are 425. That seems like a lot, and it kind of is, but remember, the 5-year average is at 4.5%. The day Russia invaded Ukraine, they were at 570, and during the pandemic, they were at 900. Credit spreads are not seeing a recession. Leonardo Fibonacci is regarded as the greatest mathematician in Renaissance Italy. His golden ratio is universal. It applies to human behavior and the stock market. The 38.2% Fibonacci retracement from the rally in the S&P 500 at the stimulus lows of the pandemic, which was 3,500, to the all-time highs to Friday's close at 5,074, is exactly 38.2% retracement. That's remarkable, right? If it's a bull market and the economy is as strong as I think it is still, investor capital will begin to start coming back into the market at these levels. Why? Investors have been waiting to see meaningful progress on trade deficit reduction and government spending cuts, and you're beginning to see them. Some of the wild-eyed emotion surrounding U.S. government spending cuts and tariff wars are illogical. There will be some transitory adjustments required by some, and they won't always be pleasant. But the fact is that, every crisis breeds innovation, and failure is a key component of capitalism. The foundations of the U.S. economy are solid. The data reflects that. And the foundations of the U.S. stock market are solid. Earnings in Q1 are probably going to come in at about 10%. They start next week with bank earnings. I think there are some areas of the stock market that aren't going to do so well, retail being an obvious one. But the fact is, in the tech sector and in the innovation sector on the industrial side, the U.S. economy is going to start doing really, really well. Investors will see that in the stock market, and investor portfolios are going to be just fine. So stay with it, watch for the data that supports this perspective, and good luck next week. Thank you very much. Bye-bye.